Hey, what's happening, guys? Dan Darrow here with another Options and Play video update. I talk about rolling and trade management quite a bit. I feel like a lot of you guys that are on the VTF probably have a pretty good idea of how I like to approach doing that with options. Normally, if it's standard calls, standard puts, a lot of the rolling revolves around closing contracts, opening further out of the money contracts, right? Locking in money, open up lower debit, further out of the money contracts to see if the trade continues, right? If I'm in spreads, sometimes that means closing out of the spreads, opening further out of the money spreads, but there's also other times when that means tightening spreads. So if a spread is 10 points wide and the stock moves in my favor, then maybe I will sell the long portion and open another long portion where I tighten the spread from 10 points wide to maybe 5 points wide. So still accomplishing like the same idea of reducing risk and locking in money, but just a different way to go about it, right? Um, Also, too, and maybe something I do a little bit less frequently is managing a trade by going from standard calls, standard puts into spreads, right? So HYG, right? This was something that I basically was thinking seemed susceptible to a pullback. A lot of other credit was rolling over. I mean, bonds, obviously, if you guys have been following, treasuries were under pressure, investment grade, corporate debt was under pressure. So when HYG was chopping around right here, right above the 50-day, and this kind of monthly trend, I thought, with a lot of credit rolling, seemed like HYG could be susceptible if it lost the 50-day. So I wanted to do a close to the money April put spread, or excuse me, a close to the money April put. All right, so it was an April 87 put. Um, I wasn't expecting like a huge point drop. It was this to me was always going to be a more modest move to the downside. Like so, I basically had the goal of the 100-day as kind of like the target for the trade, right? Like I thought if it broke the 50, that it was going to hit the 100-day. So when it sank real quick over this 2-day move down close to the 100-day, but not quite there, I obviously it came very close to the target. So like I wanted to make sure I was reducing risk or locking in money because it was a big move. But also it didn't quite get to where I wanted, so I still wanted to maybe hold on to see if it did start to build a little bit further to the downside, right? So in this case, because I was only really expecting a modest move to the downside, I didn't want to give up that 87 strike because, I mean, if I roll down to an 86 or 85 strike, I mean, that kind of like takes the trade away, right? Because like I really was never expecting to move down to those levels. So in this case, what we decided to do was we decided to sell an 85 put, right, to turn the 87 put into 87-85 put spread. Okay, so what this does is it reduces the risk by selling the further out of the money, right? So like then you collect the premium and thereby reduce your overall initial debit into the trade, right? But what that also does is that it allows you to stick with those 87 strikes, right? So like the trade is still in the money, and if it sinks, you can still ideally capture some upside on them. But then if it breaks below 85, obviously the trade is capped, and then you don't really stand to benefit beyond that, right? So in this case, we started with the standard put and turned it into a put spread, right? Now moving forward, seeing as though it's starting to lose the 100-day, right? We're sticking with it because momentum seems strong. Now I'm using that 100-day as kind of like the stop, right? So we already reduced risk, and now because momentum is strong, trying to stay with it just to see if it does start to build down into like the 85 area, right, with the 200-day. But now just use the 100-day as the stop, right? So the 100-day was the target. It's through the target. So now if it trades back above it, that'll be like the stop, and we'll probably end up closing out the trade at that point, right? Because that was the target. If it trades back above it, then I gave it a shot to see if it cracked. It doesn't, then we can close it out. Okay, so trade management, right? So it's taking what the chart's giving you. In this case, right, we had the targets were set up by the moving averages, right? And then after you have like the targets, then how you accomplish managing those trades, like rolling, is dependent upon again what your targets are, what you think the stock can do, right? And then what the premiums are in the options. I mean, sometimes it makes sense to close the contracts, roll to further out the money, but other times it might make sense to turn the calls, the puts into spreads, right? Because you want to stick with those like at the money or maybe in the money contracts, all right? So just want to, just highlight this to make you, think maybe outside the box a little bit. It's not always just, it's not always just like black or white. I mean, there can be a lot of different things you use here when it comes to like managing your option trades. And sometimes doing something that maybe is not like the most basic could really help you out a bit. All right. So, if you like this video and you're looking for more information on swing trading with options or rolling and trade management for your options, please follow up with the link in the description of the video for more information on options to play. Hope you have a wonderful night. Stay well, and I will talk to you all tomorrow.